Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. It's our third episode, so I'm excited today to have Fritz Waldvogel in. I said that right, Fritz, right?
You did, you got it right.
So Fritz has been out with Colliers Mortgage. So Fritz, appreciate you coming on.
Thanks for having me on.
So Fritz is in from Minnesota today to join us. So I was glad to get him in person for this episode versus patching him in through the internet. So that's great to see you here. So Fritz, maybe you kind of give a little brief background. So Fritz is a lender with Colliers Mortgage, someone that we personally use several times on several mortgages. So this is someone that I can say firsthand that does a great job. So maybe just give a little bit of background on yourself and Colliers Mortgage and what you guys focus on.
Sure. Yeah. First of all, thanks for having me. I'm super excited to be on. It's good to spend time with you in the flesh. I feel like we don't get to do that enough these days with COVID. But
That's right.
As Mike said, my name's Fritz Waldvogel. I'm with Colliers Mortgage. We're DUS lender, Fannie Mae DUS lender, and HUD lender based in Minneapolis, Minnesota, but do a lot of work throughout the country and Texas in particular. My focus, I work with owners, operators, for on acquisition purchases, refinances, all across the country.
So you guys focus on predominantly HUD financing and Fannie Mae financing with a little bit of LifeCo and some other originations. What's kind of the breakdown between, say, yourself? You predominantly focus on Fannie Mae. Is that right?
Yeah, that's correct. Yeah, I would say 90 to 95% of my business is Fannie. It's just the people I work with, it's kind of the focus. But we do a decent amount of HUD as well.
So how are we sitting today? I mean, it's been a strange year, and it seems like talking today, it's been much better than what we all probably thought about when we were talking to each other in late March, early April. But what was the lending environment as we were going in 2020, and then kind of where did it go, and then where do we sit today? So kind of maybe take us a little history lesson over the last 12 months on kind of your observations of the lending market.
Yeah, it's been a roller coaster, as you're aware. 2019 was a super strong year, I think, across the board. A lot of originations. The market was in great shape. But as you moved into 2020, first quarter was also a strong month or strong quarter as well. But then everything kind of went on freeze after in March or April. And the agencies, Fannie and Freddie, put on COVID escrows, so that was a change for the marketplace. Rates dropped considerably. The 10-year Treasury went from 2% all the way down to about 50 basis points. So, there was a lot of volatility in the mortgage-backed security market until really the Fed came in, kind of mellowed everything out in March or April. And as we came through the rest of the year, it seems like, volume's right back to where it was or close to where it was in 2019 as a market. So overall, I think we're all happy with how the year's progressed.
So your loan production is going to be up about 20%, give or take, and you took 2-3 months off. Is that right?
Yeah, which means everyone was really busy for those few months. So I thank our staff who've worked really hard to making sure we get all these deals done.
Yeah, that's funny. So so the rates are lower, but there's some COVID escrows in. So right now Fannie Mae has 12 months of P&I?
Correct.
And Freddie Mac has 9 months of P&I additional escrows. So you're talking 3-4% of the loan amount roughly in additional escrows up front, so that's a little bit more use of funds, but our rates are down considerably, right? So what maybe where were rates at the beginning of the year, and kind of what's kind of a typical deal that you've locked here recently?
Yeah, so I would say start of the year maybe 3.5-4%, and now you can lock a deal depending on leverage anywhere from say 260 to 3.25, 3.5, depending on loan size.
Wow, so you're down 30% on your rate, give or take.
Yeah, significantly.
So that's really helping fuel quite a bit of loan volume. So with your volume being up, just out of curiosity, how much of that is more shifted to refinances, take advantage of these low rates versus kind of new money acquisition mortgages?
I would say in the middle part of the year, once after rates dropped, we saw a lot of refinance activity, and you saw the acquisition loans really pull back as buyers kind of digested the new escrows. But as we moved into the second half of the year, acquisition business has picked up significantly, and a lot of the the traditional refinance business has slowed up a little bit. So I would say in the second half of the year was more acquisitions, middle part of the year and the beginning of the year was more refinance. refinances.
So besides getting some of these COVID escrows, are there any other like restrictions or new underwriting guidelines you're kind of seeing? As are the agencies looking at these loans a little bit different on how they underwrite versus what they would have a year ago?
Yeah, I would say they're really focused more on what are collections. What are you actually collecting for rent? And I think that's been more of a focus here. With everyone being a little concerned with if there was going to be a drop off collections, post COVID. So you're underwriting, making sure you're taking a look even in other income and, what are your late fees with some of the restrictions, instead of just underwriting trailing 12 months, you're really focused on the last 3 to 6 months, and then really focusing on making sure that the actual collections continue to stay steady throughout until closing.
Are you seeing different regional variances? Because you loan all across the country. I know you do a lot of business in Texas, and then you're from Minneapolis. So I know you do a bunch of stuff in the Midwest as well. But are you seeing different lending standards from home for you, Minneapolis versus Texas, say versus the Northeast?
Yeah, I think both Fannie and Freddie are taking a look at all the different markets because I think every market's been impacted differently. Like Las Vegas and Orlando, for example, have been hit harder than, it's like Dallas, Fort Worth in particular because of their hospitality exposure. So I think, the agencies will take a look at their current book and making sure that they're being prudent from a credit standpoint in all these different markets. With the understanding that Fannie's and Freddie's mission is to provide liquidity for the multifamily market, so they're still lending all across the country. It's just what leverage points would be prudent with the environment.
So recently, a lot of the people that probably watch this follow some of the industry news, but you see these headlines about the 2021 caps got released here recently for Fannie and Freddie, and we're going to about 70 billion, I believe, each in the cap. Any thoughts on that? I know as part of that too. I guess kind of the second part of the release was that a lot of it has to be more percentage of it has to be kind of mission driven, meaning affordable housing versus I don't know if they had quite the same restrictions. Maybe you can kind of talk through what just came out and how's that relative to what the last year we just kind of lived through.
Sure. So the lending caps for 2019 or 2020 was about 80 billion. It started really in Q4 of 2019. There was 100 billion for 5 quarters, so 20 billion a quarter. And they just came out with their lending caps for 2021 with 70 billion. So it was a little bit of a pullback, but in terms of total volume, it's really in line with where Fannie and Freddie are going to shake out for 2020. So I really don't feel like it's a big pullback, and there will be less liquidity in the marketplace. And I think in 2019, Freddie did about 78 billion, Fannie did 70 billion for the year. In 2020, I think through October of this year, they're at about Freddie's at 58 billion and Fannie's at 56. And so they'll finish out the year maybe 65, 70 billion. So it's really in line with where they were this year. And I think as you see more capital sources come back, life insurance companies, debt funds, bridge lenders, I think that'll be plenty of liquidity for the marketplace.
And so as far as like the affordability restrictions, how does that vary from kind of what?
Yeah, and the other difference is in 2020 that 37.5% of all production has to be what they consider mission rich, which is rents that are affordable to people who make 80% of area median income or less. And so they increased that to 50%. And so they're really focusing, making sure that they're doing what's to their mission is provide liquidity for the affordable housing space.
And do you have a sense, or I'm putting you on the spot, do you know, how much of the volume that Fannie and Freddie have done or will do in 2020, how much of that fit the mission rich? Was it just right at the minimum, or was it much greater than that?
I don't have the exact math, but it was much higher than the 37.5.
So you would deduce that it wouldn't have too much of a material impact because they're already loaning on those types of properties anyways.
Correct.
And we're seeing pricing, the way they kind of regulate that from my experience just being on marketplace, is the pricing might be a little bit wider on something that doesn't have the affordability component. And that way it kind of maybe makes a competitive product like a LifeCo or CMBS loan a little bit more attractive for a newer, nicer building that might not have the mission rich part, right?
Yeah, 100%. Yeah, pricing, obviously, just like you said, it shifts to what the business they're going to win. They're going to make sure that it's part of, they hit their housing goals.
Got it. And that, in my experience, maybe you can talk a little bit to this, is depending on where they are relative to the cap, if they get a little slow start to the year, it might be a little wider on spreads. And when we get into like March and April, and they realize they're kind of behind, they start cutting their spreads and getting that in. So I don't know if you have any.
Yeah, it ebbs and flows. And, I think what happened in 2019 was they did a lot of business in Q1 and it caused issues in Q3 of just getting tied up to their cap amount. So I think that they always do. You're 100% right. They won't try to buy too much business early part of the year and try to make sure what they're supposed to do is continue to provide liquidity throughout the whole year and they don't have any hiccups.
So talk about maybe a little bit about some non-agency markets like the LifeCo, CMBS, maybe some of the debt funds. It seems like those really kind of went away and really turned off in mid-March. I really haven't seen too much of that. I think we're starting to see some of the early life signs at the LifeCos and debt funds. I haven't seen as much CMBS, at least in the multi-housing space. But are you starting to see those come back on? And what do you see for 2021 kind of going forward? How much of that market do you think they're going to take on relative to kind of like current participation?
Yeah, I think life insurance companies, debt funds, banks, I think they'll pick up more of the market share in 2021 from the agencies. I agree, we're starting to see life insurance companies come back and be more aggressive, as well as debt funds. I know pre-COVID, bridge lending and debt, they were really competitive and there were plenty of players in the marketplace, but they really fell apart after COVID. So we expect for them to be more competitive in the first half of 2021 for sure.
And that'll probably take a lot of the space where if I buy an apartment that doesn't have the 80% of AMI affordability, maybe that'll be a little bit more attractive. Or if I'm buying a newer, nicer deal and want a little bit lower leverage, that's probably really the solution that fits a little bit better, or the problem that fits that solution a little bit better. Right?
Yeah, and I think the more options, the better. I think it's good for the multifamily space to have different debt options, because each transaction is different, and there's different investment objectives for the sponsorship group. So a long-term yield maintenance deal isn't the right option for everyone. I think I'm sure we'll talk about this in the show, we've seen that bite people in the butt.
Yeah, I can tell you that firsthand. Was stuck by the yield maintenance a few times in my career. Is there anything you're seeing? You guys obviously do a lot of Fannie Mae debt, as we talked about. I know a few years ago they had the structured arm product or the SARM product that was really popular and did quite a bit of volume. And then really the last 2 years, we really haven't seen much on the floating rate or the adjustable rate mortgage from Fannie Mae. And there's always rumors and rumblings that's coming out. I know you sit on the loan production committee for Fannie Mae. Have you heard, or what have you heard about that and possibility of Fannie Mae coming out with a floating? Because Freddie really has been a lot more competitive the last 18, 24 months. They've really been taking all the floating rate business has really been going into the Freddie channel, and Fannie's done next to nothing.
Yep.
Any thoughts kind of why that's been and what might change going forward?
Yeah, and it's been back and forth with Fannie for quite some time, as you know. It just seems like Freddie's made it more of a point to focus on floating rate debt. Fannie I think they do enough volume on the fixed rate business, and I think that's more their bread and butter. And I just don't feel that they've made a huge commitment to really coming out with a program that would compete with Freddie's floater. I think if you're in some of the lower leverage space, Fannie's come up with a couple programs that could be competitive, 65, 60% leverage. It can make sense, but generally, I just don't think, even as we move into 2021, that you're really going to see them come out with a program that really will compete with Freddie.
So that's kind of been more rumor than what reality is probably going to be in your estimation?
Yeah, I think it's more rumor personally. And I think with the transition, I think the other thing with the floating rate question is Fannie and Freddie were going through a conversion. They were really the first major, lender that was making the conversion from LIBOR to SOFR.
Yep.
And so there was a lot of question marks on how that was going to look like and how that transition was going to happen. And so I think as that progresses and, the banks continue to use, or Fannie and Freddie continue to use the SOFR-based cap, see how that impacts, Fannie's, desire to be more aggressive in the floating rate space.
Yeah, and I just read an article just recently that the transition, which is supposed to happen mid 2021, got pushed back. I think it was 2 years. So the banks have another couple years of transition or runway, because none of the banks were going to actually be ready for the transition, and they don't want to throw chaos on the marketplace. So it seems like there's a little bit more rope before that transition happens. And I'm sure a lot of I know all the Freddie loans have all converted to SOFR, and I'm sure there's actually now a market to buy a SOFR cap where there wasn't a market, a few months ago even. It just didn't exist. So I think it's starting to kind of grease the wheels a little bit. So hopefully that won't be quite at the impediment maybe that it was before. Any more thoughts kind of on as we're wrapping up 2020 here? Any more thoughts on kind of just the general state of the market, or any sort of changes from 2019 to kind of where we sit today?
I think it's going to continue on. I think as is. I mean, there's plenty of liquidity. The agencies are still, very aggressive on credit. Rates are still really low. There's plenty of interest only on acquisition loans. So I think that's helping, fuel some more acquisitions. So I think it's still going to be a very nice environment from the debt perspective as we move into the first half of 2021, especially, hopefully we get the vaccine and then you see the economy really come off
Yeah.
and strong as we move into the rest of the year.
So maybe we kind of transition a little bit to another part of the conversation. One of the things that I like to do is maybe give some actual tactical, practical advice from, a guy who does a lot of volume like yourself, kind of what separates some of the more professional operators versus some of the less professional operators as it relates to getting, better debt terms and really driving, driving forward. So maybe kind of talk a little bit on some of the tips and tricks on some of the people that you see that are successful versus that aren't, or any sort of stories around that might be helpful. But, when we're going through and we're underwriting loans, what are some of the things, one of the things that really, when I first started getting into it, you didn't really pay as much attention to is the appraiser and the important role of the appraiser and how we underwrite with these agency loans. So maybe kind of talk through one, when you guys get a loan application in, or you're before you even issue an application, you're sizing these deals up and you're going through and you're looking at historical income, and income's pretty much what it is, right? You guys don't make a whole lot of changes to income. Usually you're typically taking what your T3, you're trailing 3 months of rental collections and you're trailing 12 months of other income. And then and that's kind of what you have as your base underwriting going into it, maybe a couple of little variations, but the expenses can vary quite a bit. So maybe kind of talk through the basics of how do you guys kind of underwrite to your lender's pro forma on what you can actually size to.
Yeah, so on an acquisition loan, like you mentioned, you really can't do much on the income side. It is what it is. But on the expense side, if the seller is operating the property, really high expenses, high payroll, high repair and maintenance, we don't necessarily have to underwrite to that. So I think what good sponsors do is they make sure they have a strong, year one pro forma that they'll put together. They'll work with their management company, or they'll do themselves that they'll put together and say, okay, here's what we think we can operate on the payroll side. Here's what we think for R&M, admin across the board. And then obviously the lenders will make sure, okay, I believe you, we think you can operate the property that way, but we need to make sure that's verified by an appraiser with market comp.
Yeah.
And so that's where you mentioned the appraiser coming in. You want to make sure that you're underwriting to expenses that were in line with the marketplace.
Right.
And as a lender, we're going to lean heavily on the appraiser, on payroll, R&M, as we mentioned, but also taxes. I think, especially being here in Texas, the taxes are a huge piece of the equation, and how each lender, Fannie and Freddie, both may look at taxes differently. And so I want to make sure you talk to multiple appraisers, before you really dive in on the debt, to making sure that the lender's talking to them. So, hey, because the difference between 60% and 80 to 90% of appraised value for their tax value is going to make a big difference to your cash flows and ultimately your loan proceeds.
So we've done a lot of business personally together, and then you do a lot of business with the people that are newer in the business or maybe the first second deal. Maybe kind of talking through what is there any observations like a group like mine or my group or a group like mine? How do we go about when we're initially coming to you looking to get a loan quote? What do I do that maybe is slightly different that someone that's new into the business that maybe doesn't think to do because they just don't know what to do? Maybe some sort of actual tip or some things when they're working with a lender. What should they do to make sure when we're circling a loan amount that we're going to go hit, that we can actually go hit that loan amount 2 months later when it's time to actually close on the acquisition?
Yeah, I think the number one thing is having your ducks in order, because I feel like, especially with you and other strong sponsors, you have your business plan in place. So when you bring your debt team and, okay, we're looking for, here's what we're looking for. You have your pro forma ready. Here's what we're planning for renovations. So we as a lender can talk to, Fannie and Freddie directly and say, okay, here's the business plan. Here's what they're planning to do. Here's what they're thinking over the next 3 to 5 years. And with that will come, more aggressive interest only, because, okay, this is the reason they want the interest only is because they're going to do some sort of renovation or whatever. It just makes our job more clear to convey your story and provide a stronger story to the agencies.
Yeah. So coming in organized, making sure you have a duck on the row, giving supporting data, right? So, just because I'm throwing the current owner is operating at 1,300 payroll, and I'm gonna say I'm gonna do it 950, you might call BS on me.
Yep.
But if I can show, hey, here's 4 of the properties that are similar to this that I'm currently operating at 950, or the property down the street's operating at 950,
Yep.
or the management company I'm hiring has a bunch of assets they can do. That's the type of thing that's going to give you as a lender and the appraiser and ultimately Fannie Mae who's going to buy this comfort that that can be done. Is that right?
Yeah, and I think that's a good point. I mean, if you have other properties that you own in the area, you can provide those financials and say, hey, here's where we're operating at these properties at 100%, because it just provides more support to help you get a better debt execution.
One of the headwinds that we have besides taxes certainly has been insurance here
Yes.
lately.
Yep.
In a lot of the Midwest markets and Southeast markets, anything with water nearby it or has flat, areas where hailstorms come rolling through.
Mhm.
Seen quite a few natural disasters that's causing these insurance rates to really rise. That's another thing that we tend to do pretty early on is we go get an actual quote from our insurance broker and make sure that we're coming in with that quote in hand, because I don't want to assume 300 a unit when I go get a quote is 400 a unit, and that could really blow my proceeds. Anything else along those lines that you want to add to that, or anything similar on the expense side before we kind of move on?
Yeah, the other thing I would add is, playing with the replacement reserve number. Say the lender has to order a property condition assessment that'll lay out the capital needs for the project, and we'll escrow for, certain that amount basically throughout the loan term. And so one way you can kind of get away, say your debt service constraints, you need more net operating income is,
Yep.
maybe you do a deposit, some sort of deposit, maybe, depending on loan size, maybe 75, $75 a unit. Which then will allow us to underwrite less replacement reserves over the term, which then in turn will raise your proceeds. And if you're planning to do a renovation, you're going to use those funds anyway, so it allows you to maximize your loan proceeds.
Yeah, that's I think is a great pro tip there. So I'll kind of recap what he just said. So if you're going to come in and spend 5,000 a unit anyways, doing flooring and appliances and fixtures and things like that, all these things that would be on your replacement reserve schedule, because when you go get a new Fannie Mae loan or Freddie Mac loan, you guys do a property condition assessment report, and that engineer that walks the unit is gonna project out over 10 or 12 years. We got to replace 10 stoves and 10 water heaters
Mhm.
every year. And so they do this math, and they're going to make you set aside, say, $350 a unit a year in replacement reserves. It's like a forced savings account that you as the owner can draw out of quarterly and take that money. But if you're planning on upgrading the flooring and the appliances anyways, maybe you could go in and say, okay, Fritz, well, I could buy it down to what, 250 now?
200.
200.
Yep.
So I could take 150 a unit a year times however many units and pre-fund the replacement reserves. And then I was gonna spend that money anyways, right? Doing my renovation programs. And I shift it from my capital account to my replacement reserves account. But what that does is it allows me to get $150 a unit a year in additional NOI that then increases my NOI available for debt service, and then ultimately increases my loan proceeds. So I think that's a really professional tip when you're looking at these deals, to think through that. And if I was going to spend these dollars on these items anyways, maybe I can just buy down my replacement reserves and get a higher loan proceeds. So I think that's a great tip to share with everyone. So hopefully everyone got that, and then that's a real useful tip when you're putting a deal together. So, kind of maybe moving forward, what's another thing that's maybe kind of tripped some people up? We always think about on the origination, but if you're an owner operator and you have 10 other deals and multiple Fannie Mae or Freddie
Yep.
Mac loans, have you seen other things that now that we're it's easy to kind of buy these things, it's not always easy to operate and keep them full. What other issues have you seen trip people up that might be avoided?
Yeah, you bring up a good point. I mean, you have a lot of people that are just focused on doing deals, and as
Yeah.
you build a portfolio, the agencies will monitor and see how those loans are performing, and what is the condition of those assets. Ultimately, the agency loans are non-recourse. The collateral, all they really have is the collateral, and so they're really going to be focused on how do you actually maintain these properties. You do these renovations. Here's what your business plan is. How do you do executing it? Do you, making sure you report your financials on time? All those things that are important, but you need to stay focused not just on buying new deals, but also maintaining your current portfolio as well. Because we've seen, because that not maintaining your portfolio will impact your ability to get debt with the agencies in the future.
So if I have a property and I've the agencies will come out and do an annual inspection, or maybe every 18 months, send someone out there and physically go look at my property, identify, say, hey, my parking lot's got a bunch of potholes in it and I'm not maintaining my assets. So then they'll send the borrower like a letter saying, hey, you need to go correct these deficiencies we find on the property. And if you don't do that, then you get on the naughty list, I guess, for Fannie Mae, and that would impact your ability to get future debt. That's the short version. Or if I don't report quarterly and I'm behind a quarter or two on my financial statements, that also can impact the ability to get new debts.
100%. We've seen multiple borrowers have issues. And it's not, it won't allow, it doesn't allow you to get financing going forward when the agencies are a big piece of the pie. If you can't, work with them because you haven't maintained your assets, I mean, it's going to be a problem for you going forward.
Yeah, and then that also is related to that. If you have a lot of these deals, I know a lot of the loans that you put together, it's kind of almost like deal by committee a little bit, where you get maybe you have a lead sponsor and you maybe have a co-sponsor and maybe you have 2 or 3 people that are just going to sign on as a KP. Have you seen that come trip people up where I'm like, hey, I'm going to go KP or sign as a key principal, sign the bad boy carve outs for this sponsor because they don't have the net worth or liquidity to get the deal done. So they kind of get the group together, get it done. Have you seen that trip people up, or any examples you want to maybe talk about?
Yeah, we have seen that where we've seen people that have just signed as key principals or guarantors with somebody else, but maybe they're not the GP, they're just an LP who signed. Your name's attached to that deal. And so if you're just in a limited partner and really it's the general partner that's screwed up and hasn't maintained, because you're a guarantor on the loan, your name is associated with that through the life of the loan.
Yeah.
And so you want to make sure if you're doing that you're associating yourself with people that you trust and that you want to work with, because it can impact your ability to get financing in the future because you're tagged along with them for the whole ride.
Yeah, that's that's something I don't think a lot of people, when you kind of get new in the business, they hear the word non-recourse, they think there's no risk to it, and that's not necessarily true, right? I mean, these carve-outs have some real ramifications if you violate them. That guarantee could be sprung in, and then if you want to be a professional in this business, you want to make a career out of this instead of doing one or two-Z type of deal. Making your name associated with someone that might not be the most reputable person can actually have some lingering consequences and cost you, your ability to actually buy deals and operate in the space quite a bit as well. Any other thoughts or tips or tricks? So, I mean, you loan across a large part of the country. Have you noticed any markets that you think have done really well and have higher kind of future outlook on versus maybe some markets that a little bit more leery? Are these tourism markets, like you said, Las Vegas and Orlando, are those really kind of on the no-fly list a lot with the agencies?
Yeah, I think they're taking a look at their whole portfolio, and like you mentioned, the markets like the tourism-focused Orlando, Las Vegas in particular, I think have struggled more than others. Some of the coastal markets, if you look at the data, you had Greg Willett on for your first show.
Yeah.
Some of his data out of the Bay Area. I mean, serious rent drops, and so obviously that's going to impact how aggressive the agencies want to be in that space. So I really think for example, Dallas Fort Worth is a great market. It's well diversified, and you've really seen rents stay flat. So I still think there'll be plenty of liquidity here, but it's really on a regional basis. They're looking at city by city, in live data, because the Fannie and Freddie with their book of business, they get live financials that they can take a look at and see how their whole portfolio is doing, and they're going to make sure that they're being prudent at those markets.
One thing that maybe you just kind of got top of my mind here is, one of the biggest talks early in COVID, when March and April, were the forbearance. You guys have a pretty large book of business. How much approximately how much Fannie Mae business you guys have on balance sheet?
We have maybe 3 or 4 billion.
3 or 4 billion. And do you have any sort of sense of how much of that is actually on forbearance right now?
A very small amount. I would say our portfolio held up really well. I think when the forbearance agreement, that whole world that word became a much big piece of the discussion back in March and April. I think everyone was a little worried about how big that was going to get, but ultimately I think collection stayed strong, and people were able to making sure they could pay their mortgage payment, and so we really didn't have many issues across our portfolio. I think where the agencies have had more issues are some of the smaller loans,
Yeah.
with not as well capitalized borrowers. I understand like there can be issues on properties, but if you have one bad month and you can't make your mortgage payment,
Yeah.
that's probably not a great look for you.
That's that's to say the least. And I think one thing that maybe people didn't really quite realize was when the loan's in forbearance, you guys as Colliers, as the servicer, has to actually still continue to make the payment to the bondholder, right?
Correct. Yeah. So we were making it for any deal that was in forbearance, we had to actually make the principal or the interest principal payment.
Yeah, so that I think that has a real impact on your relationship, not only with the agencies, but with that actually dust lender on top of that. So it's kind of not a good look, like you said. If you had another option, you should try to take your other options before going down that route. So anything else as we kind of wrap up, Fritz? You want to kind of maybe talk a little bit about if someone wants to get a little bit more information about you or reach out to you, maybe a resource on connecting with you.
Yeah. You can reach out. My email is fritz.waldvogel@colliers.com. I'd love to connect with anyone and have a 15-minute discussion, as Mike likes to say on
Yeah.
podcasts. More than happy to do that with anybody.
Oh, perfect. Well, Fritz, definitely appreciate it. I appreciate everyone tuning in. This is Michael Becker signing off. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.